Hey, everybody, Tim Albrecht here alongside Tim Baker. Welcome to this week's episode of Ask a YFP CFP segment of the Your Financial Pharmacist podcast, where we feature questions from you, the YFP community, to be answered by one of YFP Planning's fee-only certified financial planners. Before we jump into today's question, I want to give a shout out to that team at YFP Planning that makes this segment possible. YFP Planning offers fee-only comprehensive financial planning services that are customized to the pharmacy professional. You can learn more by visiting yfpplanning.com. Again, that's yfpplanning.com. All right, Tim, this week's question comes from a member of the YFP Facebook group, and they ask, I am a stay-at-home mom working PRN weekend limited hours. I make about $5,000 a year at this side hustle, and they offer a 401k. I would put 5%, they match 4%. So first 3% match dollar for dollar, then 0.5% for the next two. The problem is fees are about $40 a quarter. Question here, is it worth investing here to get the match, or should I keep the money and invest in a Roth IRA? Tim Baker, what are your thoughts?
Yes, I'm going to answer this a couple different ways. So I think if we look at it straight up and we kind of assume that $40 is a flat fee. So I was answering this question as if, the administrative fee on the 401k. So the administrative fee is typically what the 401k plan takes to administer the plan, to set up the plan, to administer to participants, et cetera. And sometimes, Tim, that plan fee can be a flat fee, which is typically what I like to see, because for smaller accounts, in this case, it's not necessarily a great thing. For larger accounts, it is a great thing. But it could also be a percent. So sometimes that is, 0.5%, 25 basis points. It can range all over the place. And typically the smaller the plan, the larger the fee or the fee is per participant. The bigger the plan, the less it is, per participant. So if we look at this straight up as like let's assume it's a flat fee, $40 times 4 quarters, Tim, that's $160. So essentially the match has to outpace that. In this case, $5,000 times a 4% match equals $200. So that's the free money that we're talking about. So the math stands up that $200 is more than $160. So you're plus 40 for the year. So the way to look at this is that the first 3 quarters of the year, basically pay, the match pays the administrative fee. And then that last quarter, that's your free money, your $40. So another way to look at it is if you were to put that money into a Roth, you'd have $5,000 in a Roth. In a 401k, you'd have $5,040 when you kind of net it out. The break-even point, though, is that sometimes you say, "Hey, I'm making $5,000, but I'm only making $4,000 this year." In that case, that's the break-even point where that 160 would equal that 160 match. So that's really important to understand. I think the second part of this question, Tim, is like once we got a little bit more information, because I answered it as like a flat fee. When we actually got a little bit more information about like what was going on through some screenshots, it's actually not a flat fee. The administrative fee, it looks as if it is a percentage, and it's actually so. And this is kind of the tricky piece. Sometimes when you look at a 401k, Tim, you'll see administrative fee. You might see like fees associated if you take a 401k loan. There might be other like third-party fees that are associated with that. But then separate from that are the expense ratios associated with the funds that you're in. Sometimes the plans kind of blend those two things together. So in certain cases, we see like lower cost funds, a la like the Vanguard, funds that are really higher cost. But I think what happens is a percentage of that goes back to the administration of the plan. So, and I think that's actually what's happening here. And the custodian here that I will not name, I'm not a big fan of because typically there's more fees associated. But we see this basically broken down. So I'm looking at an administrative fee for per account ending on June 30th. And the total fee is $30. And that's broken down by a bond fund, which is $24.13 of that 30, a Vanguard fund, which is $4.33 of that $30, and then a Vanguard mid cap fund, which is $1.54. So I look at that like it's kind of you're wrapping it all into an admin fee, but these are actually expense ratios because that's when you see an individual fund. So I think the answer still stands. I just don't really like. I mean, if the match were to go away or it would pause, I would not pay those administrative fees. I would probably just stop it. And again, it looks like it's baked into the actual expense ratio of the funds, which are you can't avoid anyway to begin with. So this is all to say that yes, I would probably move forward with that because of the match. But it's also a kind of a point of discussion, a learning opportunity to say that not all 401ks are created equal. Some call administrative fee this. Some people call, some other plans that it's administrative with an expense ratio rolled up, and it can be really, really confusing. And at the end of the day, the 401k for a lot of people is going to be one of the biggest pots of money that they're going to grow. It's the biggest bucket of money that they're grow over time. So it's really important to understand what you're paying, how the fees get paid out, like what that looks like, and understand, your kind of priority of buckets. Do you stay with the 401k? Do you go out? I think it's just important to dig in as this questioner, this person has, and get some answers to the underlying fees that are associated with those accounts.
Great stuff, Tim. And maybe the question behind the question here is like, can I convince my HR manager, CFO, or maybe
Yeah,
this
no
is
doubt.
independent pharmacy owner? Like, can I convince a decision maker to look at alternative options? Right?
Yes. I think it's in our minds, it's easier to convince like one or two people as for like a small business than it is like a
Yeah.
corporation. But even if you've been working with, if you're a middle-sized company or even a large company, like get a second opinion, because I see so many, I don't know, I want to say, I just see a lot of waste. And
Hmm.
we typically see it in the independent pharmacy channels where it's like either they don't have a 401k because they think it's too expensive, or the one that they have because they're so small, their participants are just getting blasted with fees. So that's another call to action is like, let's just not assume that what we have is what we need to
Yeah.
have in perpetuity. And there are a lot of low cost plans out there that can kind of do the same thing for just a month. You keep more dollars in the pockets of the participant and really the business owner as well.
Yeah. Yeah. And as you mentioned, our observation has been typically the smaller the employer, the higher the fees, right? That we see on some
Yeah,
of those
no,
accounts. So
absolutely. Yep.
we beat up this topic of fees, Tim, on episode 208, why minimizing fees on investments is so important. So we'll link to that in the show notes. And thanks again for this question. Love the intentionality here, digging deeper, asking questions. Great analysis by Tim Baker. If you're listening, you'd like to have your question featured on an upcoming episode, two ways that you can do that. You can shoot us an email at info@yourfinancialpharmacist.com, or you can record your question by visiting yourfinancialpharmacist.com/ask YFP. As we wrap up, just an important reminder that this content is provided for informational and educational purposes only, is not intended to provide and should not be relied upon for investment or any other advice. For more information on this, you can visit yourfinancialpharmacist.com/disclaimer. Thanks again for your support of the podcast, for tuning into this week's Ask a YFP CFP segment. And we hope to see you again here next week. Have a great rest of your week.